Zachary Cefaratti is the CEO and founder of Dalma Capital Management, a leading asset manager and investment bank specializing in alternative investments, including hedge funds, private equity, and real estate, headquartered in the DIFC in Dubai. During his tenure as CEO, Dalma Capital has received numerous awards, including Best Fund Platform in MENA in 2018 and 2020. Zachary is the member of the board of YPO Emirates and has a BA in International Management and International Banking and Financing, having completed his studies at Franklin University, Switzerland, London School of Economics, and the University of Pennsylvania. Zachary, I'll hand over to you.
Thank you so much for having me. It's interesting to be on the other side. For people normally watching these webinars, probably used to me being the moderator. I was so pleased when our partners at Assetly invited me to share some of their notes on their presentation today. So I'm excited to be on the other side of the table. I hope everyone finds that to be enjoyable. Let me just open up our presentation here for everyone. So again, just giving a background on Assetly is one of our partners and the partner for this session. So Assetly is an experienced team in the renewable energy space, focusing on energy infrastructure, focused on greenfield and brownfield projects in solar and onshore wind. We'll dive right into the presentation itself. So again, 50% brownfield, 50% greenfield, focused on OECD, principally OECD countries, and focusing on, again, investment grade off-takers. So for the presentation itself, I'm going to be focusing on as it's titled, the third energy transition and the $30 trillion funding gap that could exist between now and 2050. Global energy demand is still principally being served by fossil fuels. This is posing an increasing concern due to carbon emissions. A lot of people feel like these are concerns that pertain to the future, but these concerns are very active today. Currently, air pollution is causing around 7 million premature deaths a year. And that is due to high levels of air, water, soil pollution. So this is very much today's problem. We've all seen, again, increasing volatility in weather patterns. And that is how much of that is driven by fossil fuels and carbon emissions is imprecisely known, but it's certainly a contributing factor. Many people live in cities that are suffering from pollution that is worsening. Again, looking at the fossil fuel stack, we're around 29% coal, 24% coal, 29% oil, and 19% gas in our energy stack. Population and urbanization growth is actually increasing underlying energy consumption. So, the need for an energy transition is quite important, not only to offset the overall growth in demand, but to actually recapture some of that demand. And we'll be highlighting some of the scenarios that we could be looking at for that energy transition. The recent shifts have demonstrated the need to accelerate the shift, which would be itself the third energy transition. So on this graph, as you can see, this is quite a long dated graph, goes all the way back to 1800. We wanted to highlight that this is, in fact, the third energy transition that developed civilization has gone through. Again, historically, human populations relied heavily, almost entirely, on biofuels. But throughout the 1800s and into 1900s, that first energy transition was from biofuels to coal. Coal became the dominant source of energy for much of the 1900s, finally being replaced by oil and gas, with renewables having only recently begun its phase of energy transition. What I really want to highlight here is that energy transitions are not something that happens overnight. These are things that span decades, that span centuries. It is, again, very early in this third energy transition, which we expect to be the most dramatic and impactful. In terms of the climate change goals and frameworks, I'm sure most of the audience are familiar with these, but just briefly highlighting some of them because they'll be referred to throughout the presentation. The Paris Agreement central aim is to keep global temperature rises below 2 degrees Celsius above pre-industrial levels. So that would limit further temperature increases to around 1.5 Celsius. Currently 183 nations in the EU have ratified this. The Kyoto Protocol aims to commit industrialized countries and actually puts most of the burden on the more industrialized countries for improving the shift and reduction of global greenhouse gas emissions. Then you have the UN Sustainable Development Goals. This is the most recent, having been ratified in 2015. And again, this addresses many areas, but energy, climate change is central to them, and will potentially have an impact on all of the others, or many of the others, but it also includes poverty, hunger, gender equality, and access to clean water. What we're going to be highlighting here is that this third energy transition is currently experiencing or facing a massive funding gap, and global capital needs to mobilize at a much faster pace. Again, it is encouraging to see the capital mobilization that's happened in recent years, and some countries and regions are certainly far ahead of others, as President Aznar has highlighted, but we still are quite far behind. And some of the numbers are absolutely astronomical. So we'll be looking at 3 scenarios. The planned energy scenario, which is the path that we're currently on, which again, this would be an assumption that energy-related emissions are increasing at around 0.7% until 2030, and then tip into a decline of 33 gigatons a year by 2050, resulting in temperature increases that will be above 2.5 degrees. So currently, based on the current path, the current trajectory, the planned energy scenarios we're referring to it, based on current projections, we will fall short of the Paris Agreement goal of 2 degrees. The transforming energy scenario is in line with the Paris Agreement targets, which would require emissions to fall at a rate of 3.8% a year, or approximately 10 gigatons. This is approximately 70% less than today's level by 2050. The decarbonization scenario is a very lofty scenario, but we wanted to highlight it from a financial standpoint, and you'll see in later slides. But this will reduce net carbon emissions to 0 by 2050. And that would actually hold temperatures in line at approximately 1.5 degrees above pre-industrial levels. Now, what we're going to be addressing is that the annual funding gap is, in order to meet the Paris Agreement, is approximately $2.5 trillion. We see that there's a need to invest around $3.2 to $4.3 trillion per year, and the current rate is around 1.2. So while that is an impressive figure, we're still far behind it. Now, I think the 2020 has been a year where $1 trillion has been thrown around more than any other year, and I feel like I think it's important to kind of put that into context, how much money $2.5 trillion is. So there are, for example, approximately 2,200 billionaires in the world. If those 2,200 billionaires all went into one room and you added up their combined wealth, it's around $9 trillion. If you got every billionaire in the world to put $1.1 billion per year of their net worth out of whatever they're investing in and into renewables, they would be able to fill this funding gap for about 3.5 years, and then you'd have the same issue over again. You'd still have a massive funding gap because all of their net worth would then be invested into renewables. If you then decided to get the entire hedge fund industry into one room, they manage about $3 trillion. That would get you through another year and a bit. The entire private equity industry would get you through another year and a bit. So I just wanted to put into context how I think it's easy to lose sight these days with governments pumping trillions of dollars in stimulus to really how much $2.5 trillion funding gap is in order to meet these goals. Going back to our energy scenario, we say kind of mind the gap that we have in investment. Where this represents where we're heading. This is our historical progress in terms of energy-related CO2 emissions, renewable share in electricity generation, and gigawatts of renewable energy with highlighting wind and solar. So where we're heading right now is a reduction of from 35 to 33 gigatons. That is based on the planned energy scenario. Where we need to be is at a reduction in 2030. Sorry, this would be the 2030 numbers. In 2030 to 25 gigatons and 9.5 gigatons in 2050, with renewables taking 86% of the energy sector by 2050. So we're again facing a massive gap in terms of market share and in terms of overall production capacity, as is highlighted on this slide. Actually, I just will mention to everyone on this session, I won't go into every number. We will distribute these slides to everyone in the audience, or we'll have them distributed by the AIM Summit team so you can take a closer look. But going back to our different scenarios, the baseline energy scenario, we are looking at around $95 trillion of cumulative investments into energy between now and 2050, with renewables being approximately 13 trillion, electrification infrastructure being approximately 13 trillion, and energy efficiency being approximately 29 trillion. The transforming energy scenario, you'll see, has a pretty significant gap between where we are now and where we need to be. Again, we need to reduce fossil fuel investment to 20 trillion and invest significantly more into renewables, electrification infrastructure, and energy efficiency. That sums up to around 35 trillion additional needs to be invested into renewables, electrification, and energy efficiency in order to meet the energy demands of tomorrow, but also offset fossil fuel consumption in order to meet the Paris Paris Agreement. Again, the decarbonizing scenario has a much more dramatic gap. So we add another 20 trillion or so to the $35 trillion gap. So looking at around a $55 trillion gap in investment from where we are headed and where we could be in the decarbonizing scenario. But just to give you an idea of the scale and magnitude of the investment needed. As President Aznar highlighted, some regions are leading others in terms of their renewable share in the energy stack and their investment per year that we expect between now and 2050. In 2017, we had from the last year from which we have reliable figures, we have Latin America leading the pack, and unfortunately the MENA region trailing the pack in terms of renewables share of the energy stack. I think that this is changing quite dramatically in MENA from what we're seeing at the moment, but probably again due to the fact that there is abundant fossil fuel resources in this region. It has not been able to capture a significant market share of the global stack. Again, won't dive into these numbers too extensively, but what we're also seeing is very promising outlook for change. Investors are changing their mindsets, and what we're seeing is a very strong, very active global adoption of a mindset towards ESG and impact investing. This is part of it is due to negative or exclusionary screening. In terms of assets, global assets under management, around $19.8 trillion are now doing what's called negative screening, meaning that while they won't necessarily proactively go out of their way to invest strictly based on ESG criteria, they will screen out potentially negative impact areas. In terms of ESG integration, we have another $17.5 trillion and around 10 trillion focused on shareholder engagement. So, but it is certainly promising. Again, it's hard to go to an investment conference these days where impact investing, ESG investing is not central to the discussion. And it's certainly a space where institutional investors like to be working with managers that are allocating capital. But it's not just a matter of feeling good about investments. There's actually strong justification. If you look at performance of ESG criteria managers, they have actually generated demonstrable alpha. So if you look at the excess returns generated by ESG funds or ESG portfolios, you'll see that there's actually been an excess return of around 3.3% in North America and 6.5% in Europe, which is again quite encouraging, quite promising. I think the hedge fund industry would be very happy to be delivering those kind of annual alpha figures. So and these are again annualized numbers, not just cumulative over that period. So so there's a strong case as an investor to be looking forward and investing in ESG criteria. The economic benefits are also quite dramatic, and I think it's important I think one of the benefits of COVID, for those of you who know me in the audience, you'll know that I'm always someone who looks at the glass half full, and have always looked for opportunities in crisis. So, and I think what COVID has done it's woken us up to inaction, to what can happen if we ignore the experts, if we fail to act when we have fair warning. Without a vaccine, COVID by 2024 would wipe around $35 trillion off of global GDP. Again, a staggering figure. Now, we are looking at a scenario where massive amounts of capital have been mobilized in order to find a vaccine, and we have several promising vaccine candidates on the horizon that are likely to deliver late into this year and throughout next year, and that will mitigate the financial impact to around $8 to $10 trillion. Again, that's still more than half, approximately half the size of the U.S. economy, being wiped out of global GDP that will never be seen again. Again, we will restore growth and we will come back, but those years of lost productivity will never come back again, and we'll be paying for the consequences of this for many, many years to come. So I think that this has woken up people to the potential detriment of inaction, but also the fact that action can be profitable, that there are opportunities in crisis, and that those who are on the right side of it and are putting capital into these opportunities, whether they be vaccines for COVID or projects that are focusing on renewables, stand to gain from the negative externalities that these are potentially causing, and that they are, again, hopefully preventing. If you look at the yield to economic return from investment, you have a substantial savings in terms of the offset of negative externalities that a lack of action would cause. So it, again, is estimated by the IRENA report, which came out this year, that on the very low end, negative externalities without without a change in investment driven by coastal flooding, driven by climate change, driven by indoor and outdoor air pollution would result in at least around $40 trillion of lost GDP and as much as 120 to 150 trillion dollars of lost GDP. So we're talking about, again, an investment that is not only profitable for investors who are getting behind this trend, but also will result in significant reduction in negative externalities. And again, that's something that I hope that COVID has taught us a lesson about. That the time to act is ideally before the crisis becomes too dramatic. The mobilization of capital is probably the best way to solve these crises. Again, government support, as President Aznar has highlighted, is also can be very helpful, but it's actually not something that the renewable sector any longer relies on to deliver good returns to investors. Again, another reason for or kind of opposition, as you can probably tell from my accent, I'm an American. I was born and raised in California, and in the United States there are a lot of skeptics, and one of the sound bites for not shifting to renewables is that somehow this would protect jobs. And again, anyone who has a basic understanding of economics will understand the concept of creative destruction, and that actually the renewable sector will create jobs, create much more jobs than are lost. Yes, jobs will shift. Yes, it will have an uneven balance on different regions, and some may suffer more than others. But at the end of the day, the offset of jobs created by the transforming energy scenario more than offset the job losses. And the other question is, again, job quality. Again, we're all increasingly concerned about our lifestyles, and I think that the quality jobs, or the job quality in the renewable sector compared to mining coal is quite advantageous. So we're looking at approximately 63 million new jobs that are being created in the renewable energy sector between now and 2050. And again, the recent shock has also highlighted instability of fossil fuel prices and a need to accelerate to cleaner forms of energy. This is a heat map that shows some of the changes and progress in solar power generation from 1999 to 2019 over the past 20 years. Again, I think these graphs speak for themselves. So I'll allow you to review them upon circulation, but I think that it's important to, again, highlight, as President Aznar alluded to, that the sector is much less dependent, no longer dependent on tax credits in order to be profitable for investors. Again, the public sector did the important job of effectively subsidizing the industry for some time, but it's no longer the case that it relies on it. It's obviously a benefit when it's there, but in terms of the how the renewable energy stack is going to develop and continues to develop, we see, while the other all forms of renewables are certainly important, we see solar as leading the pack in terms of growth as part of the renewable energy stack. Again, the technological developments in solar have been quite substantial and are set to continue. So as you can see, the expected growth between now and 2024 across the stack is significantly tilted towards solar PV growing the most. And this is, again, I think the most important driver has effectively been cost. Solar was actually able to reach cost parity with coal in 2017, and is now cheaper than coal. So the justification, another justification that we have in the United States is that somehow shifting to renewable forms of energy will be tantamount to a tax on people paying for higher energy costs. This is a myth. This is simply a myth. Their solar is cheaper and continues to get cheaper, and is again becoming very competitive with fossil fuels, and has fallen below coal in terms of the electricity costs of production. We again have had continuous growth in the utility scale contracted pipeline. There was a very slight dip in 2018 due to a brief tariff-related issue, but we're seeing increasing growth in the pipeline and the quality of the pipeline. So it's certainly, there's reason to have hope, but we're still far behind where we need to be. This sector is only going to grow, and I think it is still early. So for investors looking to deploy capital in this space, certainly the time is now to be paying attention if you aren't already. And without further ado, I'll hand back to Joseph.